Our next presenter is Barrie Jones Cook, who will be presenting Financial Analysis for Technical Professionals. Barrie has more than 30 years' experience in network engineering, from telephony and ATM traffic analysis in the mid-90s, when she was approximately 4 years old, to BGP and automation over the last 25 years. She founded Barrie Jones Cook Consulting LLC in the mid-2000s to help smaller ISPs scale their networks, and has traveled all the way from San Diego to join us today. It's her third time presenting at NANOG. Her first talk at NANOG was a lightning talk called "Is Independent Consulting for You?" at NANOG 91 in Kansas City in 2024. Welcome back, Barrie.
Right. Well, I'm going to start with a little story time today instead of all this. Long, long ago, in an office tower far, far away, a young engineer, apparently 4 years old, had gotten a job following the jobless recovery of the early 90s. And I don't know how I got the job, but I managed to get that job, and it was at Wiltel, which was a small company that got its start when somebody invented a machine that would pull fiber through old pipelines as it was cleaning them simultaneously. So they had a really cheap backbone, but they still had to get to the end users, or basically just long-distance telephone callers. And this was very expensive. You had to wait a long time. They would sometimes, if they were really small companies, take weeks and weeks, like 8 weeks to provision. You just never knew, sometimes months. And so it was a conundrum. If you ordered too soon, your circuits would be sitting there idle. And if you waited too long, people would pick up the phone to make a long-distance telephone call, and they'd get a fast, busy signal because there were no lines available. So an entire traffic engineering department was formed, and our goal was to predict those peak lines required during the busy hour, which is, the Erlang B formula, if you're familiar with that. And we'd compare provider costs as well, and also identify T3 channels that could be groomed. So if you're not familiar, a phone line is a DS0, and then 24 of those fit onto a DS1, and then a DS3 can hold 28 DS1s. So a lot of times they'd get disconnected and there'd be a lot of empty space on the DS3 channels. So you could identify which ones could move, you could turn off some of the unused ones. But the fairy tale ended at some point because WorldCom decided to buy Wiltel. And this is a little misleading here. Where I put the arrow, that's not actually when they bought it. They bought it more way down here in 1995, and then this was the dot-com boom. And so, when the boom was going on, my lesson, which was cut costs, use your engineering to save money. But when the dot-com boom was going on, nobody cared about saving money. Just build it out as quickly as you can. So that kind of brings us to this cycle of financial thinking. It waxes and wanes. Markets will correct, then easy money runs out, and suddenly we're aware that everything costs money, even setting up for peering. Or if you're trying to do a startup, instead of immediately getting money, it draws a lot of scrutiny. So you could say all engineering decisions are financial because even when they feel like they're not, eventually that comes back. So let me go back to here and just point out that I am not a lawyer or an accounting professional or anything, so none of this constitutes advice. But I'm just here to hopefully give you any ideas if you need something that you can figure it out from here that will help you with financial analysis. Because it is important at various points in the cycle, and it will be important later if it's not now. And definitely seek professional help if you have any questions about anything legal or any kind of formal acquisition or anything like that. And of course, sanity checking LLM outputs. So, if you are, if I've convinced you to care about engineering or financial decisions as an engineer, you probably fall into this camp here, the internal camp, where you're trying to get somebody like your CFO or your CEO to allocate budget to a project you want to do, particularly automation, as we saw yesterday on the panel. That can actually be really helpful in convincing your bosses to buy into that. But you may also find yourself in a situation where you have an entrepreneurial idea, you want to start up a company, and that would be more of an external type of decision. And of course, this is, not everything falls into these two camps. But is the distinction all that important? Maybe. You might make different types of points in your presentations, but really it's the same consideration. Somebody has to allocate a finite resource like money or your hours of work, and they need it to return a benefit. So they want cost savings or profit, and cost savings is really profit anyway. So there's always a risk that won't happen, and how do you reassure them? The other way that this might benefit you is personally. You might want your own finances to be better managed, so you want to learn about this so you can do that. Or you might have an idea that you want to move from engineering into more managerial side. And that's not the focus of this presentation, but I wanted to share a couple of resources I've recently found useful. So if you are interested in financial analysis, where do you begin? And like anything, traffic engineering or anything like that, the other kind of traffic engineering that we just talked about in the previous presentation, or BGP or anything like that, you had to sit down and think about it somehow and Google stuff or ask ChatGPT. And you just have to, think it through. And then you'll find the next thing you need to know, and then the next thing and the next thing. But it does help sometimes to have some background. And for me, that was GNU Cache. I installed it for my personal finances way back when and discovered that it had business accounts. So then I created a file where I unchecked all the personal finance stuff and just checked the business accounts, like you can see here. And then I added additional accounts, such as these capital expenditure accounts that I added in as an example here, like a data center one and a transport one. And then you're always going to have some kind of account, like a checking account where money comes from. So all of this is pretty self-evident, but whatever is not, you can look up, like what's an asset, what's an expense or a liability, what's the difference, and all that kind of stuff. So you can look all that up while you're going through this, and then generate something like an income statement. But at some point, if you want to model the costs that you're dealing with, you need something more flexible, and that's typically Excel spreadsheets. But don't worry, we're not going to just do all accounting in spreadsheets here. We're going to get into some Python in a little bit, so stick with it. But for sheets, most of you probably know it's best practice to put your assumptions in their own cells, like I've done here in green. And then you want to reference cells rather than constants in your formulas. That way, if you want to change something, you don't have to go through and find all the places you've multiplied by that in your formulas. It's pretty self-evident, but it's less obvious than you'd think for some people. But and so here's another example of that. This is a different tab. The previous tab here was just my sales. I made a super simple example for this, so it would actually fit on a slide. So there's not a lot of detail here, but you're of course going to have a lot more detail when you model your finances. But I just have like 4 data centers where I'm putting in a single rack maybe, and this is my sales projection. And then this next one that I was showing you is my OpEx. So, and then you want to create a summary sheet, because it's ideal to have many, many tabs where you're modeling all the different kinds of things. I would ideally have had a CapEx one, but I made it really simple for this, so I could just put it in the summary here. And then you summarize it all in one tab and pull in all your totals from the other tabs. And if you keep them vertically, you can easily calculate things like I'm showing here in results, or, I was pointing at the monitor rather than this. Okay, so results, or you can create a chart very easily. This would show something that maybe your CFO would be interested in seeing, which is, oh, how do the OPEX and CAPEX balance out with the revenue and eventually have a positive cash flow, which is the green line. And I will come back to that chart in a bit. But if you're doing something more than just an internal, like, give me some money, and you don't have to be all that rigorous, you may want to analyze some risk, like that risks that come in. So those are the possibilities for negative returns. If, for example, your assumptions in the green cells that we saw were off, or your conditions change, or even the assumption of what formula you need to use to project out sales or OPEX. But even if your model is good, there could be a better way to invest the capital or allocate that, departmental budget. So why should they do your project? And or fund your project, rather. So there's a couple of key metrics that decision makers like to see that you've thought through this, and to kind of show the potential of an investment. And then to really dig into it, if somebody's really needs some convincing, or it's an external type of situation, you might want to do some sensitivity analysis to really evaluate whether your model was good, or what are the conditions where, even if the model isn't good, where are the conditions where it could still be a good investment. So the two most common metrics I've run across for this are NPV and IRR. NPV is net present value, and that's the value of an investment in today's dollars. Say you loan your friend $100, and in a year they're going to just give you $100 back. That may not be such a great investment unless you just want to do it for your friend, because you could probably invest that $100 in a CD or something for 4 or 5%, maybe, if we're being generous. So then that's the discount rate, that percentage that you could get in an extremely safe investment, rather than investing it in your friend who may or may not be an investment. And I'm doing all this yearly in my examples, but if you want to do this for monthly to go into much more detail, depending on your situation and who you're presenting to, just don't forget to divide the interest rate by 12. You cannot divide by 0, right? So IRR is kind of related to NPV. It's basically your return on investment, but it factors in the discount rate again. And it's essentially, what does the discount rate need to be for the NPV to be 0? So what's, like that break-even point. Some other things to think about that we're not going to go into here are, net income. In my model sheet slides, I showed that I had a little asterisk. I didn't stop and talk about it, but I pointed out on the little asterisk that I didn't include things like debt. It was a super simple example, so it doesn't include all that stuff. Servicing your debt, like with interest and payments, or non-cash expenses like employee stock purchase plan, or not purchase plan, but like where you give employees stock as compensation, and other things where it doesn't involve a direct outlay of cash. You might want to include those, and that would be more like net income. And if you were looking to borrow to finance your project, then you need to consider probably debt service coverage ratio. And that's basically demonstrating that you have the cash flow to cover your debt service payments. So that's like principal and interest. And so every month or year that you're paying, you need to have enough coming in to cover that. And that would be a 1 for the ratio. But a lot of lenders will want to see a little bit better than that, like 1.25 or 1.5. And you can consider a lot of other metrics as well if your audience wants to see them, and you would know that by asking your finance department or something. Or if you're a startup, maybe you're working with an incubator and you can ask them. So I'm going to dive into the net present value here, and the reason why is because it's really confusing in Excel. So this is the canonical definition. You have a summary of a series of cash flows. So in my example, it was 5 years, but I had a year 0 payment up front where I had a payment, but I didn't have any revenue coming in that first year. So that's year 0. And we're all familiar with starting at 0 when we count, but a lot of finance people aren't, so that's, I'll get to that in a second. But a discounted cash flow is where you divide the cash flow by basically 1 plus the interest taken to the power of the year that you're talking about. So year 0 is a 0 exponent, and that means you're just dividing by 1. So the year 0 payment is not discounted. But in Excel, and I think it was Excel was the first one that did this, but somebody can fact check me on that. One of the initial spreadsheet makers decided people wouldn't be able to count from 0 maybe. I don't know what the logic was, but they only put this part in the parentheses in the NPV calculation. So if you did put your year 0 payment in there as the first year, you would get an incorrect answer. It will be less than what the actual NPV is. So you need to add the cash flow payment for the first year on separately from the rest of the NPV calculation in Excel. And then all the others have sort of followed suit. If you try this in Google Sheets, it's the same thing. And that's what I was using here. So I did add the first year on separately in this slide. But in this one, in the blue, you can see that it's actually, whoops. Sorry. This one right here is actually less than what it should be because I included all 6 years starting at 0, and it actually comes out a little less than what it should be, which is 151. And this is how you can prove it to yourself, is you just make a series of discounted cash flows and sum them up. And it's actually the correct amount of 151K. If this is all this with the same cash flows and the same discount rate, of course. So yeah, just be very careful with Google Sheets or any other sheet you use, because most of them will do it wrong. But weirdly, if we're moving on to IRR, year 0 is included as it should be. And as I mentioned before, IRR is what does the discount rate need to be for the NPV function to be 0. So if you set the NPV function to 0, you can't solve it algebraically because it's a sum. So what it does is, what the Sheets does, is it iterates through different discount rates, starting with a guess rate, which you can specify, or you can just take the default of 10%, and then it runs through this until the NPV is close to 0. And the point is this project's rate of return better than an alternative investment like a CD or whatever we talked about before? And here's the Python I promised, and there's more, don't worry. This is not all of it, but NumPy Financial has an IRR function. And if you don't, you can write, obviously you could write code to demonstrate it iteratively, but I didn't wanna, because I can show you how to prove it to yourself that this and the sheet version are correct. And that is, you can do this in Sheets like I did in the blue right there, down there on the bottom, and I get 26.48%, which is the same as we got for Python. And the way to prove it to yourself is you put that in for the discount rate in this green, I keep doing that, this green cell over here. And when you do that, you get the NPV is close enough to 0. If I wanted it to be actually 0, I would have to go out a few more decimal points, and it's not worth that. So, sensitivity analysis. Most of you, if you're trying to get your boss to do an automation project or something, NPV is going to be fine. You probably don't need to do all this. This would just be if you're facing a little bit more scrutiny, or you're just concerned on your own that your model's not great. You just want to see, like, what are the cases where this might not be a good investment? So there's a couple that you can do. There's a tornado chart. This is a really simple way to show some consideration of the risks. And then you can dig into it a little bit more with some really good statistical modeling, and that's the Monte Carlo simulation. And of course, there's probably many other ways. These are just ones I've used, and they're not foolproof, but depending on who you're talking to, it can give them an idea that you actually thought through it. So a tornado chart is, what is the impact on your key metric, for example, NPV, if you change some of the variables one by one. And you keep all the others the same, and you change something like I did 50% variation on CapEx, and then I held CapEx the same, and I did 50% variation on OpEx, and so on. And I calculate the NPV each time to get low and high values. So the horizontal, it's basically horizontal bars. This is how you show the results, and then you sort in reverse order. So they're kind of in descending order, so it kind of looks like a tornado. And I'm using Python again and Matplotlib. But to create my inputs for my scripts, I am using the sheets to do the variations. So here's my delta CapEx, delta OpEx, and delta revenue. And then I calculated NPV for each of those cash flow series. And the pink ones are my positive high values, and the purple ones are going to be the low values, and they're all negative. So those are shown here, the arrays of low and high values, and then calculate the impact, which is just absolute value of the difference. And then you calculate your mean and delta and all that kind of stuff, and sort in reverse order. And I tweaked captions, fonts, and colors as needed, to make it fit the Nanog slide format. But that's not shown here because I have a GitHub repo for you, and you can look at all the code and dig into it if you're really curious. But this is what I came up with, and the break-even is the red line, and obviously the mean is the middle line there in between the light and the dark colors. And so sales, if sales changes by 50%, then this is the impact, for example. That's the top one. All right, so Monte Carlo simulation is, like I said before, just a way to really dig into this. Most of you probably won't need it, but it's nice to know it exists, and it's kind of fun to do if you like statistics and Python and Matplotlib. But you can model just a ton, like more than you would think you would want to do, of potential cash flow outcomes. And if you assume they're normally distributed, which is like a bell curve, then it's kind of like when you're rolling the dice in a casino. So that's why it's called this, a Monte Carlo simulation. And what we did for this example is calculate NPV from this every single time you simulate it, and then see how likely you get a positive NPV value. So here is me pulling in for my CF means array. All it is just those numbers that I calculated for the cash flows earlier, just the baseline value of those. And then I'm showing the font management here in case you're interested, but it's also in the repo, of course. And then calculate the array of standard deviation values. You can have a different standard deviation for every year of your cash flows, or you can just do what I did and just do a blanket 40%. And then you have to specify your discount rate and the number of samples. I'm going to run it 10,000 times just to make darn sure I run the gamut. So, and that's the second part here is running that Monte Carlo simulation with the means, the standard deviations, and the number of samples. But you have to, before that, specify a random number generator in the current versions of, what is this? This is Matplotlib, yeah. No, NumPy, I think. Yeah, NumPy. You have to specify a random number seed or not. And I did so that I could have it be reproducible. But if you leave out the 42 and you just leave it blank, then you can get a truly random 10,000 samples. And then I separately calculated the discount factors, which is basically the denominator of my NPV calculation, because it just made it easier. So then I computed the NPVs after that, and then I'll plot it. And this is what I came up with. And it does make a nice bell curve, but it's also varying a lot, so you know it didn't just make a bell curve deterministically. And the red line, again, is the break-even point. And risk of loss is 11% because that's the area under the curve to the left of that break-even point. And also the important one here is the 5th percentile right there, negative 50,000 or 51,000 if you round up. And you can say this in a presentation like losses are not going to exceed $51,000 with 95% confidence. And that's what that 5th percentile lets you say. And that's called value at risk, or VAR. So that's, like I said, for presenting to decision makers, you can use that information. And before we get into that, it's really important for engineers to realize that most people that you're talking to don't care about all the details and the dollars and cents. You probably do recognize this, but I need the reminder personally because I like to show lots of detail, so it's good to point it out. And just round everything to the nearest million or 100,000 or whatever, and don't include cents or anything beyond the decimal point in your currency. So sorry, Penny, you're leaving us. But the important thing is the decision makers are going to want to know what's the upshot. So lead with your end goal, like I want to allocate, you know, $500,000 to build out some DCs, or I want to, it's going to cost this much to automate because we're going to have to hire more engineers, or our engineers are going to have to do more. And you can have a little bit of a problem statement, a couple slides of why, but mostly you need to be really clear about how much money you need and when, mainly. And then, so you can put all this on an at-a-glance slide with some of the graphs like we've done in the previous slides. And then what you're asking for, what are these important data points like the NPV, the metrics, basically, what is the risk? So you can keep back a set of more additional, like more detailed slides, or like your business case, you can have it handy to draw from in case there's questions. But I think for most people, you just want to start with something like this. And so there's that chart that I showed you earlier, which just shows the cash flow. Bottom right, you can see all those key metrics we just talked about, like the NPV, the IRR, and the VAR, the value at risk. And then the assumptions for like how I built that sales model are kind of up here. And then basically in the middle here, what am I asking for? Well, $400,000 to build out the data centers and $764,000 over the next 5 years for OpEx. And these three at the bottom could have been summarized and it would basically be $764K. But I spread them out just to kind of fill up the space. But you will probably have lots more tabs than I did in my super simple example here. And that way you'll have a couple of spots for that. But I also decided in this example that made sense to kind of put a map of where I was going to put those data centers. And that it's just kind of like to tell this, something simple to tell the story at a glance. And yeah, that's about it, except you can absolutely learn this. I just want you to know, because like I did, and I'm just an engineer too. And of course, get that expert help if you need it, especially for if you've introduced risk by using an LLM, make sure you prove it to yourself. And then if there's any question, get help. And of course, any question of legality or model sanity or any other risk that you've introduced. So that's people from like your finance department or your legal department or the startup incubator we talked about. But you're probably going to need external due diligence or an audit anyway if you're doing anything formal or acquiring another company or anything like that. So here's the GitHub repo and my contact information if you don't want to ask a question today, but you think of something later. And with that, are there any questions? Comments? No? Thank you.
Let's go, y'all. Let's keep Barrie up here. We've got some time. Anybody?
Anybody?
All right.
All right.
So we've got about 14 more minutes before our
Uh-oh,
next
Patrick.
presentation. That's fine.
I'm scared of Patrick.
I'm sure Jeff could fill that time quite easily if we let him. But we do have a question from Patrick.
Hi,
Hi.
Patrick, affiliated with Tigger and can't see you anymore.
I'm still here.
So I mostly stood up because nobody else was asking a question, and I just wanted to say this is the best Nanog presentation I have seen in years. The number of engineers that come up and like go, I want to spend $50,000 and they have no idea why or what or have any way to put it. The fact that you put this all into a GitHub repo and let people like actually figure it out and explain what NPV is, kudos. Thank you very much.
Thank you. I appreciate that. Yeah. Oh, wow. I didn't need to be scared of Patrick, I guess.
Hi, Tony Tauber from Comcast. Also appreciated the presentation.
Thank you.
What do you find, or how do you think might be helpful to think about when you mentioned automation a couple of times, and obviously that's always on people's minds at Nanog. I have a sense that the managers tend to think of automation as a capital thing, like you do it once and reap the rewards forever.
Right.
But I think mostly know that it's not that, because there's maintenance, there's upkeep, other inputs change and you have to adjust, some API things that you're drawing from change, or there's security vulnerabilities that you have to patch. How do you suggest to think about those things?
Well, I would just think through, like have a tab for workforce hours, right? It's the bulk of it for automation, or at least getting started with automation, right? Of course, you'll have maybe some servers that you're going to dedicate to it. That might be CapEx. But yeah, you just have to really think through all the costs, and that's what they're going to want to see. Like for your company, that could mean you need to hire more engineers, or it could mean the people that are currently there are going to just work more, isn't it? I think somebody at the AutoCon Zero, I heard them say it just takes twice as long to do anything when you're trying to automate, because you have to do your day job and then you also have to dedicate the time to automation. So if the people are salaried and they're willing to double their workload, great. Then that's not necessarily an OpEx. Yeah, it just depends on your situation. But yeah, you have to, I would just get out a bunch of sheets and start thinking of all the costs that it's going to incur that you may not have thought were costs, but they are, because people have to do the work, or you have to get AWS credits or something. So
Okay, thanks.
yeah, and if it is ongoing, it's OpEx. If it's a one-time expense in general, right? But definitely ask the financial professionals. I'm not that, so yeah. The question, Jeff.
Have some comments from online. Daryl Newcomb, unaffiliated, says, great presentation. Not a question, but if time on common errors for percentages, 5.2% is 0.052 and not 5.2 in formulas. Folks make that error in a few different places. And it's just one of dozens / hundreds of rates. It can remain hidden.
But the question was, is there an error in like one of the slides that they noticed, or is it more that they're just saying be careful? Or
I think he's just saying be careful.
Yeah, for sure. Yeah.
Matthew Pitak, unaffiliated, says, just echoing what Patrick said, thank you for a great talk. Very necessary, no particular question.
Thank you, I appreciate it.
And Daryl, again, says, great presentation. Different way to underscore the value. Quote, I am a better investor because I am a business operator, and a better businessman because I am an investor, unquote. Attributes that to Buffett Munger. This aligns with many folks' personal experiences as well. May not be a precise quote, but repeated frequently and is good wisdom.
Thank you. Yeah, we actually had this conversation yesterday too about the automation, and then just how this kind of stuff is good to add to Nanog's programming. I think not always technical, but sort of technical with the financial formulas and stuff, but not the kind of technical that we normally see, right? So yeah. Hi, go ahead, sorry.
Hi, my name is Colleen, and I'm with Amica Services, LLC. And I have a quick question about how you use this modeling to help you with taxes, or if, I know every year it's required, so I wasn't sure if that was something that you...
Oh, you mean like with personal taxes or with taxes for the business?
For the business, of course. Yeah.
Oh yeah, that is not my area of expertise. Yeah, definitely get some tax professionals in for sure. I would assume, yeah. Oh, so maybe you're asking about how I had mentioned that taxes are not included here? Or is that?
Yeah, I realized that this isn't about taxes.
Yeah,
I realized
I
you're
did
doing
not.
a lot of financial modeling, so I was just wondering if maybe you use it somehow to help you understand how you're going to be filing your taxes, or if you can use it as part of your process for filing taxes with your business.
Yeah, so I mean, definitely you have to have tax accountants, for the business, because that's, that's a legal implication for sure that engineers wouldn't be able to solve. But if you wanted to include taxes in your model, then I would assume you would create another tab. Like I said, you always create another tab and then pull that in as a column if you want to put taxes in the cash flow calculation. Yeah, if you want to deduct that from your cash flow.
Okay,
Available.
and I've noticed I just have one more question. You've been doing a lot of this modeling with sheets. So I think you've referred to Excel sheets and Google Sheets. So you're using both of these.
Oh,
interchangeably
I've used
with-
Excel in the past. I think they were the first ones to come up with an NPV formula, and it was wrong. And so I just wanted to point that out in case people were going to use it. But yeah, you don't have to use any one or the other. You just have to be careful that the formulas are doing what you think they're doing. So.
And then you've posted this on your GitHub account, and I'm assuming you have the sheets in the GitHub.
Yes.
Just for examples of how you can use this.
I can't remember if I was able to save it. I saved it as one type of file, the sheet part, and then I brought it into Mac numbers and things were wrong. So, or the fonts weren't coming up or the formulas didn't line up or something. So just be careful with that. But I think I did put a link to my actual, I made a public Google sheet with this model.
Oh, like a README file that kind of explains what's included.
No, I mean, like it's a link that you can go to the Google sheet and just look at it and play. You can get your own copy of it in your Google account and then play around with it. Yeah.
Great. Thank you so much. I appreciate it.
You're welcome. Thank you.
Chris, you were up before Les.
Sweet. Yeah, Chris Grundeman. I have some comments, thinly veiled as questions. One, I guess, would be, I think this is amazing, right? And especially for a 30-minute presentation, the breadth of what you covered here was fantastic. I think perhaps the next step, and maybe the question is, are you going to come back and talk about like ROI? And what I mean there is that, understanding the cost of a project is absolutely excellent. And to Patrick's point, I mean, being able to bring this to your manager the way you presented, right, with the map and everything is fantastic. I know a bunch of managers that would love to see this and be able to approve things much faster. I think the next step beyond that is the return on investment, which is being able to go in, to Tony's point about automation, where maybe there may be ongoing costs and OpEx for either licensing or support or internal staff, but there's also some kind of return on that, right? There's a reason where you're, more than just, hey, I want to build out 4 data centers. There's some business reason behind that, probably, hopefully, otherwise it probably won't get approved.
Yeah.
And so looking at not just the costs involved, but also the benefits involved, I think is kind of rounds out the rest of the story. So I don't know if that's something that you have on your radar for adding to this GitHub, or maybe this is just beyond something that people could go look at on their own. But I just want to add in that piece of kind of there's benefits to all these projects as well. And sometimes if you go to your boss and say, hey, we're going to spend $1 million over the next 5 years, but I'm going to save you $2 million, that becomes a lot faster and easier.
Yeah, and that's kind of what the IRR is. It's just that's your return on. That's basically return on investment, but with the discounted cash flows. So if your NPV is 0, that's the break-even point. Then you've made 26% on this particular example.
Oh, perfect. Thank you.
Yeah, but for an automation project, that's going to look different. It's going to be more like savings or something, right? Those will be your positive values in your revenue column instead of revenue. Maybe it might be cost savings or what you could. I don't know what it's exactly called in when you're dealing with that just internally with
money we did
payroll
spend,
or whatever. Yeah, payroll or something, payroll reduction or something. Yeah. But you can modify this for that example by making that be your positive value is what you're saving or something. Yeah.
Awesome. Thanks.
Les?
Hi, Les Williams with Netflix. And Barrie, thank you so much. I was really looking forward to this presentation and it didn't disappoint. I appreciate
Thank
it a lot. I think it's funny, Chris mentioned what he just mentioned because it kind of teed up where I was going with this, is for the engineers, there's mostly like, this helps with the cost and all that.
Yeah.
But the assumptions for them to get started how do you source that? What are some of the advice that you can give? Where do you find some of those revenue numbers that you can articulate to show the benefits? Where do you go to look at what a good rate of return or the discounted rate should be, and things like that? That gives you the base level to translate into the model to give you the results. So some insights as to how folks can go about that. would be good.
Yeah, that's a good point. I didn't really talk about that. For like, say you have a startup idea and you think it's going to make this much money. Well, how do you know what that is, what you could sell it for? You have to just do market research, I think, to get started. I think that's typically how we've gotten started on that part of it. The revenue model is driven by looking to see what other companies that are doing a similar thing are charging. And if you have like a value add, then kind of trying to estimate what that would be worth and what you could price it for, and then put that into your revenue model. But yeah, they're all just assumptions, and that's why you want to do the sensitivity analysis, is because, well, maybe your assumptions are off, and when you're doing something brand new, you don't really know necessarily, and so that's part of the risk, is that you've modeled it incorrectly or something. But if it's within your company and you're trying to justify doing something like automation or whatever, then you would get payroll numbers maybe from your payroll department. You have all the resources probably in your company to know what things are costing. And so you would just go talk to all those people, make a tab in your spreadsheet and put that part of the model in there, bring it into the summary, and so on. So thank you.
One more question over here in red.
Hi, this is Quincy from Cloudflare. On your summary slide, we had the aggregate numbers for example, the one I noticed was transit, right?
Yeah.
A lot can go into transit pricing, like who are my transits? What commit price do I have with them?
Yeah.
Are we buying more from them year to year? Of how much are we going to be peering away like 2 years from now? So you quickly can get into like the minutia. A lot of details go into. So then that's a tab, and then maybe a sub tab for that and that. So are there best practices for avoiding like spreadsheet soup?
Well, at some point, these are just assumptions, right? And you have to just be careful to outline that when you're presenting. Be like, this is just our assumption. We did our best guess based on, we went through all this analysis, and you might want that to be in an entirely separate sheet too, right? And then just get something that can be more simplified as an assumption, like an average peering number or something like that. And then you bring that into the tab in here for the purposes of, creating those cells, those costs in the summary.
Gotcha. So like time box each thing and then get a good enough number.
Yeah, good enough, right? So a lot of these people don't want to know the minutia. Like, oh, it depends is not a good answer when you're talking to your CFO. You can just say, well, this is the average expected cost. And then that's the sensitivity analysis is where the variations kind of are modeled into that. So
thanks.
Yeah, thank you.
All right, that brings us to the end of our questions, I
All right,
believe. Thank you so much, Barrie.
Thank you.